Well, hello. Welcome back. I'm joined here with Josh, and we just want to have a quick conversation with you all about something that I'm actually going through right now. And that's this idea of like, should I be going fixed? Should I be going variable? What should I do next? There's lots of uncertainty in our environment right now, with what's happening south of the border. We're even in our own election cycle right now. So, Josh, help me out here. What should I do?
Absolutely, Jay. This is always a great topic, fixed versus variable interest rates. It's something that people debate all the time. And right now, there's a lot going on that makes this decision even more complex. With the new tariffs from the United States and Canada thankfully not hit as hard as expected, but with all the other global geopolitical uncertainty and our own upcoming election, there's actually a lot in the air. And to top it off, we've got a Bank of Canada rate announcement coming up next week on the 16th. So the big question is, will the Bank of Canada continue to cut rates, making variable rates more attractive? Or will fixed rates see further declines and be the better option? Right now, the US tariffs are increasing the risk of a recession, not just in Canada, where we've already been flirting with one for the last couple of years, but also in the United States and globally. And if we do head into a recession, the Bank of Canada will likely respond by cutting interest rates to stimulate spending, borrowing, and investment, as we know. But here's the flip side. If the recession is caused by tariffs, which it would be, and since those tariffs also cause inflation, the Bank of Canada may actually have to hold off on rate cuts to avoid fueling further inflation. And that really leads us to what can we actually expect? Well, the market is currently pricing in about a 50-50 chance of a rate cut from the Bank of Canada next week. And we are expecting kind of two more quarter% cuts between now and the end of the year. So if we don't get the next one next week, it's still likely that we'll see two more maybe in June and again in August or September. Now, after that, variable rates are expected to kind of hold steady for a year or two before starting to rise again. However, let's talk about fixed rates. Stock markets, especially in the United States, have seen huge losses, wiping out trillions of dollars in value. If you're hiding under a rock, you might not know, but that's kind of been all over the news the last little while. A lot of investors, what they're doing is they're pulling their money out of stocks and moving it into government bonds. And heck, even that's getting shaky. And just like with supply and demand, when there's a surge in demand for bonds, the yields or returns, those go down. And lower bond yields, that means lower fixed mortgage rates too, but they tend to fall a bit more slowly than what happens with variable rates. So one strategy to consider is this. If today's variable rates are close to the current fixed rates, and with some lenders they really are, you might choose the variable option to take advantage of these next couple cuts that are probably going to happen. And then if fixed interest rates do drop a bit later, then you can convert over to a fixed rate, and hopefully over the 5 years, you'll have saved more over time.
It's really hard to know what a 0.5% really means, though. So it'd be really great if you could show me, like maybe even on a $400,000 mortgage, right? Like, what does it cost if we go up a half or down a half from maybe the 3.9?
Okay, no problem. So to put some numbers to that, Jay, let's look at a $400,000 mortgage with 20 years remaining. And I picked that because we're talking about renewals. And though the trend would be similar on a new mortgage with 25 or a 30-year amortization. At a 3.5% interest rate, which is lower than what's really available today, over the next 5 years, you're going to pay about $63,000 in interest, and you're going to reduce your mortgage principal by around $75,000. So your remaining balance would be about $324,000. At a 4% interest rate, which is closer to today's rates, you'd pay around $72,000 in interest, and it's about $9,000 more. And you're going to pay off a bit less principal, leaving you with a balance of about $327,000. So it's about $3,000 more owing and about $9,000 more paid in interest at about $100 more per month. And then, of course, if rates go all the way up to 4.5%, you're looking at almost $82,000 in interest in that scenario, with a remaining balance of $330,000 after 5 years. So really, if you're looking for peace of mind, to help you sleep at night, locking in at around 4% might be that middle ground. It might not save you money compared to the variable, but it can protect you from the risk of higher rates, right? So ultimately, it really does depend on your comfort level and what works for you as a person.
Fantastic. Thanks for the insight, Josh. As always, we do this every week. So next week, we look forward to meeting here once again. As always, if you like our videos and subscribe to them, it really helps us build our channel. Take care. I hope you have an amazing week.
Thank you.